Hi, everyone, and thank you for tuning in to part 3 of our Business Succession Planning and Insurance Essential series. So to start off, we are going to be introducing the role of estate planning in family business and how insurance can play an important part of that. And then we're going to follow up on two main topics that we're focusing on today. So the first is using IFA as an insurance strategy. And then next, we're going to look into what to consider for IFAs or immediate financing arrangements. So I'm first off, I'm going to introduce myself. I'm Jillian Wade. I'm on the portfolio management team at Yorkville, and as well Yorkville's CFO. For those of you guys who don't know Yorkville, Yorkville Asset Management is a boutique wealth management firm with clients across Canada. Our focus is managing money for high net worth individuals and families and foundations and institutions. Next, I would like to introduce Blair, who's at Botsford Law. Blair, I'm going to pass it off to you to go through your extensive experience.
Yeah, thank you so much, and thank you to Yorkville Asset Management for this opportunity to speak again. Yeah, I'm a trust and estates lawyer, will trust and estates lawyer, I guess more accurately. I've practiced for over 25 years, specializing in this area, so all aspects of estate planning, estate administration, and related topics. I'm a member of a variety of professional organizations, the Law Society of Ontario, of course, Canadian and Ontario Bar Associations, Canadian Tax Foundation, the Society of Trust and Estates Practitioners, and the International Bar Association. So definitely get lots of continuing education and professional connection in on a regular basis. And I frequently write and speak on topics related to wills, trusts, and estates. And that's, I think, how I found myself in this situation.
Perfect, Blair. Thank you. Just a short list of achievements. And so next, I'm going to introduce Sandrine. So Sandrine is an insurance specialist at YAM Financial Solutions. That is Yorkville's insurance arm of our business. And Sandrine, I'm going to pass it off to you to introduce yourself.
Great. Thank you, Jillian, and thank you, Blair, for going over that. So I'm Sandrain. I'm excited to be speaking at our third webinar about IFAs today, as many business owners are interested by the benefits of this strategy and ask me why this strategy is not as popular. So I'm an award-winner insurance manager, currently at YAM Financial Solutions. Since I joined Yorkville, I've worked with individual, family office, and corporations to ensure that they have adequate insurance coverage. This includes helping clients implement estate planning, generational wealth strategies, and other tax savings strategies and fortify their business with insurance.
Perfect. Thank you so much, Sandrine. Okay, moving on to the next slide. So over the year, we are having Sandrine and Blair host 4 webinars on business succession planning and insurance essentials. So Blair, I'm going to get you to go through the topics that you're covering over your 4 webinars.
Yeah, so the first one was sort of a broad look at estate planning and trust and how they relate to key themes around asset protection, asset management, and some tax minimization. And then in the second webinar, I talked about shareholders agreements and their importance for business owners and really how that ties in business governance and structuring into people's estate planning. So today I'll talk about sort of some legal elements or considerations around IFAs. And the game plan for the last of the webinars in the series is really to kind of complete the discussion and tie business succession planning to estate planning. So we close the loop there.
Perfect. Thank you, Blair. And so Sandrine, can you actually take us through, and I'm going to move to your slide, the 4 insurance strategies that you're going through to complement Blair's topics?
Yes, thank you, thank you, Jillian and Blair. So insurance has a big role in estate planning. So in our first webinar, we talked about just using insurance and the growth of life insurance. And then in the second webinar, we went through key man insurance and how to make sure that business are protected when there's various shareholders or when there's a key person in the business. And today we'll be exploring IFAs as an insurance strategy, making sure that people understand what it takes to do an IFA, as well what to consider within an IFA from an insurance perspective. And then in the last webinar, we'll explore other strategies to preserve and drive both business and estate values.
Perfect. Thanks, Sandrine. And so let's get started on today's topic. So again, this is the third of 4 webinar topics. So if you haven't checked out the first 2, we'd encourage you to do so. You can reach out to Sandrine or Blair and they can provide you a link. Sandrine today is going to start off by going through an IFA, how it works, and how an IFA compares to life insurance. And then Blair will be taking us through using IFAs for estate planning and then getting into the legal considerations with corporate IFAs. So with that, Sandrine, I'm going to pass it off to you.
Great. So first, I would like to mention IFA structures can be done personally or through the business. For the purpose of this business succession webinar, we will be focusing on how it affects the business. So an immediate financial arrangement known as an IFA is a strategy that allows businesses to purchase a life insurance with the purpose of estate planning and business succession. By choosing a participating life policy with high early cash surrender values, the business can use that as a collateral and lend against it. So the business owner can get a life insurance when they have a need and will be able to still maintain liquidity so they can invest in their business. The minimum for IFA is usually a cash value of at least $50,000 a year for 10 years or a total of $500,000 as a minimum loan. So here are the 9 steps of an IFA. Step 1, you purchase the life insurance. Step 2, you take a loan on the cash surrender value, which is usually up to 90% of the premium. Step 3, the business can invest the loan, which will generate a higher return than the interest rate, which has recently been 4 to 5% at prime rate. Step 4, business either pays the interest or capitalizes it and add it to the loan amount. Step 5, the corp will be able to use the deferred interest and out-of-pocket premium payment as expenses. At death, the death benefit will have grown and would be able to pay out the loan and interest, and the rest is paid to the corporation. And then the last step is that the balance of the death benefit is paid as a tax-free dividend to the shareholder's estate. Additionally, most of the time, the CDA is greater than the death benefit and would allow the shareholders to receive other capital gain tax-free from the corporation. This strategy requires corporation to be comfortable with leverage and risk. It is a long-term strategy, meaning it's not a strategy that can be undone and could face a negative return if canceled in the earlier years of the policy. The main need of the strategy is the life insurance component and a positive cash flow. And it's a great strategy for a corporation that want to generate wealth and reduce payable taxes. So benefits of IFA versus life insurance. So here I have a comparison of an IFA versus just getting someone who wants to just get a standard life insurance. So first of all, corporation will benefit of tax saving with the deduction compared to a standard life. So life insurance is not tax deductible unless it's done through a loan like an IFA. Provides an increase of net estate value with minimum investment compared to life insurance. Flexibility, as most IFA structures offset within 10 years, and offset meaning the life insurance is able to pay its premium through the dividend that is generated by the participating life policy. Points to consider, as mentioned earlier, interest rate may vary, so that can be a risk long term. Historical rates have been higher than current rates. There's also longevity risk as interest accumulate. It will also affect the death benefit over time. Reviewing the loan terms and condition is important. Blair will touch further on other things to consider from that perspective. CRA deduction rules may change over time. It's also important to review with a lawyer and accountant to make sure it's the right strategy for you. Here I have an example of an IFA versus a life insurance. The example is based on a 56 male non-smoker who's healthy, comparing if he were to take a standard term life insurance he would have only coverage for 10 years. So over 10 years, he would be paying 130,000 for 4 million of coverage. After 10 years, he would after 10 years, the policy would get canceled unless it's renewed or converted at a much higher rate versus taking a permanent pay 100 with an offset. I explained earlier what an offset is. In this case, it can offset at year 16 with the IFA structure. The client pays an annual payment of 123K, takes a loan. His out of pocket over 15 years is around 149,000. Benefit death amount reduces over the years, but the client would use the tax deductions, have a CDA credit, and still have a death benefit of over 2 million at age 86, something he would not have if he were to take a regular term 10, and it would be a very similar investment. The IRR, which is the internal rate of return, is 16% after 20 years or 9% after 30 years, which is considered as a good return for an annual return. So with a similar investment to a term life, the client is getting a strategic tax saving strategy, generational wealth tool. The client can also consider a pay 10 or a pay 20 with an offset over 12 years. The total investment is that strategy is negative to zero, meaning the client would have taken advantage of the life insurance in its living with a higher IRR. This requires the business to have had the ability to pay a higher premium. So it can also be a higher risk since it is a greater loan, but it also comes with a higher return. At age 86, in this strategy, the client is looking at close to 4 million in death benefit, with an IRR of 19% at age 86 versus close to 2.5 million in death benefit, and an IRR of 16% at age 86 for the other offset. A third option we can consider is a pay 100 with an ADO. This will also require a higher investment and a bit of a higher risk, but it could have higher values. An ADO is when we do additional deposit in the earlier years of the policy. So the policy could offset earlier, but we would need to compare those scenarios on an individual basis, and values and return will change based on the age and the coverage amount. So I'll leave it off to Blair.
Thank you, Sandrine. So that's lots of details and lots of numbers, and some people may know lawyers tend to be a little bit allergic to numbers. Not so much the estate planning crowd, but definitely my talk won't be numbers and math oriented. So as mentioned earlier, throughout the previous presentations, my segment has had sort of three focuses, like main goals of estate planning, which are asset protection, asset management, and tax minimization. Not all apply to every issue that we're talking about. And here, the focus is more on asset protection and tax minimization. And as with insurance generally, I mean, there's a real value to estate planning in terms of protecting assets, in that you're helping minimize risk generally, but also providing liquidity because, especially when a business owner passes away and their shares, that's their asset, falls into their estate, and they're trying to protect their family, their loved ones, meet their legal obligations and their tax consequences of being deemed to dispose of assets on death. So they have a game plan for what their estate's supposed to look like, what's supposed to happen for their family, and also the surviving shareholders of the company probably would like the business to have continuity and keep going after the one person dies. So the liquidity that insurance provides, really, it's there for the company, make sure it's going to be an ongoing concern. The surviving business owners are not put at risk. And in terms of dealing with, say, share redemption, the postmortem planning for the person who's passed away, having that mechanism to balance out those competing interests, not collapse value of the business, not have people scrambling to figure out how they might satisfy the buy-sell requirements under a shareholder agreement, keep people whole. You don't want to be doing a fire sale of assets or all of a sudden the company having to extend itself with borrowings that could otherwise be used um, for ongoing operations. So insurance generally is going to help address some of those issues. But the unique aspect, as Sandrine has highlighted it with the IFA, is that it can be more cost effective. So you get kind of a win-win scenario of the protective features of insurance, but you're not depriving a company of the immediate liquidity, immediate cash flow. And that sometimes can be a concern and maybe a resistance for business owners. Think I'd love to have insurance, but I don't know how I keep my business going and get the wonderful benefits of that protection I need. So this is a different perspective on achieving those goals. So on the tax minimization element, I mean, where interest deductibility applies, so the borrowings of the company, and being able to deduct some or all of the interest can further make this more affordable, and that just helps reduce the cost of doing the strategy. So tax minimization, I mean, insurance, as we've covered before, pays into the corporation on a tax-free basis. There's the bump up in the CDA. Tax accountants can go through specific calculations and looking at how things apply in specific situations. There are some rules around what is the cost base of a policy, what is the actual tax-free amount, and the addition to the CDA. And then, I mean, for people who might have some extra proceeds in the company, retained earnings, and they're able to put them into the permanent insurance, I mean, this can help them from going offside the small business deduction. And so, there's some, I'm going to say, lesser known benefits of using insurance generally, but in particularly the IFA. So lots of bang for the buck that can come with this that helps really with people's estate planning and business succession planning. So over to the next slide. So legal considerations. I wouldn't say the strategy is heavy on legal considerations. As Sandrine pointed out, I mean, the company is going to be signing up for some pretty sizable borrowing. They're going to want to look at the terms of the loan closely. Wouldn't be a bad idea if they ran the financing terms by their lawyer and just make sure that it's clear and understood, and that this is a long-term commitment, and the policy is securing the loan. I wouldn't generally expect that the shareholders would be providing additional guarantees, but given the commitment here in terms of the other financing they have in place and the overall needs of the business, they should be thinking about that and making sure that doesn't put pressure on other borrowing, other commitment. They're not taking on unanticipated risk. And then obviously the company needs to be able to pay premiums, and that's generally a financial concern in the company, to the extent that depending on what the corporate structuring is in terms of who actually has to approve big transactions like this, they double check and just look at their corporate governance. Who signs off on this? What level is it? One signature, two signatures. Does this need a shareholder vote? So check in with the corporate lawyer and make sure the right people are going to approve this. Um, for this to work, there needs to be an appropriate and valid beneficiary designation. It's going to be the corporation, because that's really kind of how pieces come together. Policy pays to the corporation, gets the bump up in the CDA. So people don't want to accidentally say name other shareholders or family members, thinking that's how you tie it together with the estate planning. There are different ways to do that and through the terms of the shareholder agreement and people's individual planning, but definitely don't want the proceeds going outside the corporation. That's going to create an issue. If the company's facing looking at an exit strategy and contemplating part of, what the long-term plans of the company are, and, this is going to be the insurance is going to be a valuable asset of the company and how that might be addressed on the sale of a company and how they might want to extract the policy from the company. That's not straightforward. There can be tax implications. So thinking ahead of time about, is the insurance in the operating company or at a company level, to make sure that there's flexibility down the road and you're not in a scramble to unscramble the configuration you've got because you've decided to sell the company. So there are a few considerations, not too many, but yeah, looping in appropriate legal team uh, uh, would be useful. Thank you.
Perfect. Thank you. So this gives us all a lot of information to digest, and people may reach out for questions, but I do actually have a few follow-up questions for both of you since we have some time. So Sandrine, my first question for you is, how does it work with the loan component? Like, how long does it take? Who submits the application? Or is it all together?
Yeah, that's usually people's main concern is that how do we go about everything? So ID advisor will work with client during the entire process. First, we submit the life insurance application. Usually will take a couple weeks to be approved, up to a couple months as well. Then we look at submitting the IFA loan. That is usually an easier process as long as they're eligible for it. Lenders we work with are specialized in the IFA structures, so they will look at it as just IFA so they understand how it would work. The IFA application will take 7 days to be approved. Generally, it's available for 45 days once it's approved. Once the life insurance, that gives time for the life insurance to be approved and settled. And once the loan is approved, the business pays the premium, and then the lender will reimburse the loan after 2 business days. So you need to first submit the insurance premium, and then the loan will give it back to you within 2 business days. And my job here is to make the process as seamless as possible.
Perfect. Thank you. And Blair, I know Sandrine and you guys talked about lawyers and accountants, but involved in IFA, when should someone be involving their lawyer when they're putting an IFA in place?
Well, I'm going to say sooner than later as a general consideration. Definitely not after everything's signed and just say, "Hey, lawyer, would you file this with the corporate records? Look what we've done." I would say either at the time of starting the application process, just to make sure, corporate counsel trying to get time on people's calendar. Any professional's calendar can be a bit challenging, and giving them a reasonable opportunity to review loan agreements, what have you, look at who's going to have to sign off and approve this, how does this maybe, so as you're getting through the planning process, it looks like you're pretty close to doing the submission would be kind of ideal. Or as soon as the application's out the door, before the approval comes back, so there isn't maybe too much excitement on the parties, and they just sign off and they don't wait for the lawyer. But yeah, so sooner than later, but definitely when the application's first out the door, would be the latest that I would do it.
Okay, perfect. Good to know. Well, thank you, Blair. Thank you, Sandrine. Thank you for your time. And everyone, thanks for tuning in, and make sure to check out the last of our 4 webinars. Have a great day.